Draper. Joining me today is Dom Guiliano, Portfolio Manager from Magellan Financial Group, and we're talking about the money that's being created to establish a firewall in Europe to stem the problems in the European debt crisis. Dom, there's a large amount of money being assembled. Where's it actually coming from, and what's its purpose?
Yeah, okay. Well, Mark, perhaps if we take the second part of the question first, in terms of what is the purpose of this firewall. What's happened over the last few years is that fixed income investors have become very concerned about the financial situation of a number of countries, in particular slower growth, highly indebted countries, and the fears first kicked off with Greece, Ireland and Portugal. And so those fixed income investors began to walk away from providing financing to these countries, and their fixed income rates began to shoot up and liquidity dried up. And so the European Union wanted to address the situation and step in and construct some funding firewalls to ensure that the markets were comfortable that these guys could roll over their debts, financing could be provided, maturity, when their debt came up to maturity, financing would come into place. Yeah. Now, a lot of complexity over in Europe, politics, who's going to pick up the bill, etc. And then, of course, the economic situation in these countries actually deteriorated, it got worse. And so markets began to lose confidence, and then they began to look around. Who else has got huge levels of debt, low growth? Italy and Spain. And so that panic began to kick off in the second half of last year as well. So that's why a firewall needs to be constructed, to try and make sure that the markets are comfortable that financing can be put in place for some of these countries.
At an affordable rate.
At an affordable rate, absolutely crucial. So the second part of the question is really, where's the money coming from? Who's providing it? Yes. Right? That's a lot of money.
Yes.
So there's actually been a couple of iterations as to constructing this firewall, and the first iteration kicked off in the middle of 2010, and something called the European Financial Stability Facility, the EFSF, yes, was put together with a funding availability of about 440 billion euro. So it's a special purpose vehicle. European unions have provided guarantees to that vehicle. Yeah. That vehicle can go and borrow in open markets at a low rate and then give that money that they raise to these countries with problems. So that's 440 billion euro. And then also the IMF and another EU entity put together another 310 billion euro. With the 440 gets you 750 billion euro of total funding capacity from that action back in 2010. Now, Portugal and the Irish bailouts have already consumed some of that capacity, and out of the original 440 billion EFSF, that's come down to about 250 billion. So that was the first round of firewalls, and then you had the whole problem with Spain and Italy kick off second half of last year, and markets began to think, you know, there's 750 billion euro of capacity. Spain alone has got about 650 billion of debt. Italy has 1.8 trillion. Right. You might be able to bail out Spain, there's no hope with Italy. Yes. And then the markets got spooked, government bond yields went through the roof across the Euro region, particularly Italy and Spain, second half of last year. The EU got together again back in October, and they announced a second facility to say we're going to pull together $1 trillion worth of financing.
And do you think that's enough, or what's the figure do you think is needed to extend the crisis?
The trillion should be more than enough. The thing to be careful here is to differentiate between countries which are really insolvent and those that are solvent.
So insolvent countries, Greece,
absolutely, maybe Portugal. So Greece is definitely insolvent. Question marks over Portugal. You know, Italy and Spain are solvent.
Yes, it's just a matter of controlling the borrowing rates, basically.
Exactly right. That's exactly right. So, that firewall of $1 trillion was put in place end of last year, and it's got to be remembered that these are temporary facilities. Now, there's a second firewall which is being discussed that's due to kick in halfway through this year. It's called the European Stability Mechanism. The terms are still up for debate, who's going to pay for it, how much, etc. Yeah. It's probably going to have about $500 billion capacity. Right. Now, those are the two general firewalls people talk about. There's really one other firewall, which is provided by the European Central Bank.
And that was the one was announced very late last year.
Yeah, exactly. It's a capacity that they have. You know, European Central Bank is essentially a lender of last resort to banks. And what they did in December of last year is to say to European banks, come to us, we'll give you as much 3-year funding as you want at 1% cost. And 489 billion euro was taken up by 500 banks.
And there's another round coming up, I think, at the end of February as well.
Exactly right. End of this month, 28th Feb, there'll be another round, and the market is talking about perhaps $1 trillion worth of take-up there. Now that's incredibly important, because what's happened since this facility came into being at the end of December is that markets have become a whole lot more comfortable that banks, solvent banks, can finance themselves at reasonable cost. Those banks quite often actually buy government bonds, and that's actually caused government bond yields to come down big time. So Italian 2-year bonds have gone from 7% to 3%. 10-year bonds have gone from 7.2 to 5.5%.
Which is a massive difference. It's like cutting interest rates in Australia for home loans by 1% and 2% to big.
Exactly right. So confidence is coming back that these governments, particularly Italy and Spain, can deal with the issues.
Yeah. That's great, Tom. Thanks for that. We'll be having further updates on the Euro debt crisis. Stay tuned to the website for further details.